And a very good afternoon. We are live with SA Stock Pick Session 2, building on an incredibly successful session last week where we brought you 6 investment specialists, 18 opportunities in terms of investing in the South African stock market. We're looking to create the same energy in today's session, and we have another 6 industry specialists all teed up with 3 stock picks that they're going to put forward to you in just 6 minutes each. A quick run through of our specialists today before I introduce the CEO of the JSE. We have Anthony Clark, Simon Brown, Chris Reddy, Pete Fillion, Alwayto Noche, and Rajeh Ambakar. Gentlemen, I hope you are waiting firmly with those stock picks ready to hit the timer as we go for that 6 minutes. Dr. Leila Fourie, let me bring you in right now, CEO of Johannesburg Stock Exchange. This all started with a challenge from David Shapiro as we move into today's successful session to come.
Thank you, Bronwyn, and good afternoon, everybody, and welcome to the second iteration of the SA Stock Picks, which is powered by the JSE. As Bronwyn said, and as I mentioned last time, a few weeks ago, I shared a graph on Twitter showing the extent to which the SA market trades at a discount relative to emerging market and global peers. Bruce Whitfield thought that was quite a brave graph to share, but the reality is that the widening discount suggests that SA equities are undervalued. And as Warren Buffett famously said, whether talking about socks or stocks, I like buying merchandise when it's marked down. So in quintessentially 2021 style, we convened this Market Minds meeting to debate their top stock picks of the moment in simple sound bites in an open forum. At our inaugural event, market commentators shared their views on key drivers of growth and also both locally and abroad. And after last week's insightful first round, I'm really keenly anticipating the second session. So from resources to industrials to financials, we heard 18 compelling cases for SA equities, both large and small. The reception has been overwhelmingly positive. I'm really impressed. The site has been viewed more than 3,800 times and counting. And as a result, I'm really pleased to announce that this is going to become a regular feature going forward. So follow the Twitter account for more updates. And whether you are joining us for the first time or whether you're back again after last week, we really hope that today will leave you inspired and excited about investing in the South African equity market. So Anthony, Alwayto, Simon, Chris, Rajeh, Pitt, thank you all so much for sharing your time, and thank you to Valdine for coordinating and organizing this. Back to Bronwyn and Valdine to kick us off.
We're going to jump right into the session now. Anthony Clark, I hope that your heart is beating fast. So you are taking to the podium first. You have 6 minutes, but let me tell you a little bit about Anthony Clark. He has 27 years experience as an equity analyst on the JSE, covering small and medium caps, and it's industrial, agricultural, and food stocks, which is why I suppose when I put out a video on Omnia, Anthony, you were the first one to come in. I'm wondering whether that's going to be in your lineup today. You also, sir, are independent and opinionated. Anthony Clark, you have 6 minutes.
Thanks, Bronwyn. Good afternoon all from a very chilly Cape Town. I'm hoping the 3 stocks I've chosen for you this afternoon will hopefully warm you up. I've got 3 different stocks: a large blue chip, a mid cap, a small cap, and then a special situations. So I'll start off with a small cap stock, which is a one I've been following for many years. The benefit of being a small to mid cap analyst for the length of time I've been covering the stocks, which is now nearly 27 years, is you have a history and a knowledge of a company, which is difficult to ascertain as a younger analyst who perhaps only picks up small cap companies for a short period of time. In many cases, I've covered these stocks for 20, 30 years since listing, and you grow and understand the business over time. One of those stocks that I've covered for many, many years is a Natal-based company called Combined Motor Holdings, or CMH is its common mnemonic. It's trading currently at around 20 Rand a share. And the reason I like the company is, firstly, the owner of the company, Jeb McIntosh, who is still the CEO of the company despite being 74 years young, founded this business back in the 1970s, listed the company in 1987, and is still in charge of the business today and remains the majority shareholder. So it's a motor dealership. Its main brands are Nissan, Ford, Mazda, and Suzuki, with a nationwide presence. Now, during the lockdown period in COVID, we all know that car sales fell quite sharply. They fell by at least a third. CMH, as a family-owned, managerially owned business, hit the ground running. As soon as COVID happened, they cut costs. They actually laid off staff. They pulled back their car rental business quite sharply. They sold excess inventory, and they actually conserved cash. So for the whole of 2021, when the results came out in February, the earnings and revenue were only down by around 10% because they'd hit the ground running and beaten the big boys in actually cutting costs and right-sizing their business. The other interesting thing about CMH is half of the market value, approximately 750 to 800 million Rand, sits in cold hard cash. So on a 20 Rand share price, 10 Rand and 8 cents as of this morning is sitting in cold hard cash. So it's a comfort cushion. Aside from that, the stock has been trading at a large discount for quite some time with a very low price earnings ratio. Now, I was in Durban a few weeks ago meeting the CEO, and he indicated to me the first half would have been spectacular. And then, of course, we have a recent lockdown. So I'm hoping that as the second half kicks in, it's an August interim, a February year end, the company will make up a lot of a loss in the first half and come back guns blazing in the second half. I value the stock at about 35 Rand and is currently trading at around 20. So I'd say as my small cap pick, I'm choosing Combined Motor Holdings. My slightly bigger cap stock is Afrimat, a stock that I've covered since its listing in 2006. Now, this company came in as the World Cup construction boom actually occurred in construction materials, did exceptionally well. And as we all know, after the World Cup finished, the construction sector in this country basically went pop. Afrimat, unlike many other companies, conserved its cash, didn't go on an acquisition spree, sat back and waited to buy cheap assets from companies who was in distress, and they ended up buying some extremely good businesses to diversify themselves away from construction materials. They moved into industrial minerals, and latterly they've moved into bulk commodities, which is iron ore and coal. Again, why I like this company, again, run and owned by extremely competent managers who know how to allocate capital. They've had a consistent track record of earnings growth. And despite the recent concerns that they're moving heavily into bulk commodities, particularly iron ore, and the iron ore price is up 23% in the last month, what they're building is a diversified mining-related company. And I have to stress, they have truly exceptional quality management, debt-free, very cash generative. And whilst this year will be a fantastic year because of iron ore, there may be a slight speed bubble in the next 6 months because of the weakening iron ore price. But we've got coal coming through, manganese coming through. So for the longer term portfolio, I would use any short-term weakness in the Afrimat share price to actually pick up some stock. It's a truly astonishing company, and at about 60 Rand a share, it's near its 52-week high. And year to date, I think the stock is up about 38%. Now, the last stock that I'm going to choose is a special situation. And I'm very well known on my social media page, Small Talk Daily, for actually bringing special situations to the light of the market and particularly my client base. One that's recently caught the imagination is a company that listed on the stock market in the 1940s called York Timber. Now, this company trundled along for many, many years, and not a great deal actually happened. Then in the mid-2000s, they decided to expand, and for 1.7 billion Rand, they bought Global Forestry Products in 2007, and the peak share price of York at that time was 15 Rand a share. Within a year and a half, the company had crashed to 2 Rand a share as they simply took on too much debt, too much business, and the company struggled. So 12 years later, the share price basically went nowhere. So if you're an investor in that company, literally in 2008, compared to where it was 2 weeks ago, you would have made no money, no returns, no dividend, literally in 12 years. Sadly, the passing of a CEO a couple of weeks ago was announced, and an activist shareholder, realizing that there was a vacuum in the company, decided to come in and perhaps make a play, given the net asset value of York. At that time was over R9 a share, and he was trading at about R1.75. They bought a stake, and they quickly fired up the market. And as it stands today, the stock is trading at R3.30, which is up about 88% in a fortnight, showing you that the JSE continues to have value in certain small caps if you know where to look for them. And as the opportunity strikes, somebody comes in and pounces. So York Timbers has had a good run. There's a lot more work to do to unlock value and to unlock capital. But as it stands right now, for those shareholders who like a little bit more risk in their portfolio, particularly the private clients, I think that York Timbers has an interesting time ahead. And I think the coming weeks and months, as the two parties, A2 Investment Capital and York Timbers, get together and negotiate the best way forward, there should be some more money on the table for investors. So Bronwyn, those are my three. Hopefully some stocks to warm you up this chilly day.
Definitely warming up this session, Anthony Clark. And of course, you can follow Anthony Clark on Small Talk Daily Research, that also on his Twitter platform, for just looking at combined motor holdings. I love it that you gave us a target price on that. Currently tracking at 20 Rand, and you're looking for 35 Rand. That's definitely setting the stage for more target prices to come into the conversation. Then, of course, speaking to your bigger mat, your bigger cap, Afrimat, you can fault Andries van Heerden. You spoke about the leadership of that organization that stands strong. And we love that special situation, which is York Timbers. Anthony Clark, Small Talk Daily. Right, next up, Simon Brown. Tough act to follow there with Anthony trailblazing. Simon is the founder and director of Just One Lap. And this, of course, is a free investor education platform. So you're a columnist at FinWeek, Business Day, TV host, MoneyWeb radio host. In fact, Simon, you are nothing short of a media mogul. But on top of that, you have categorically said that you are an investor first. You're a talker, you're a chocolate eater, you're a wine drinker. Have I missed anything out? Yes, sir. You're a photographer as well. Simon Brown, you have 6 minutes.
Thank you, Bronwyn. And I'm not an Arsenal supporter. The soccer team I supported, Manning Rangers, went broke after winning the Premier League back in the 90s. So I don't support soccer anymore. I got three stocks today to look at and potentially put on one's radar. The first is Murray & Roberts. Typically, I don't like construction stocks. They boom and bust. Those cycles between are incredibly long. I remember the early 2000s when they were 6 Rand. By the time the World Cup came, they were over 100 Rand and quickly went back to 6. Some corporate action a couple of years ago with the Germans getting a chunky stake, 45%, wanting to do a delisting, getting nixed by the Competition Commission. But what I like about them is they're no longer traditional construction. They're not the civils that we used to. They've moved into oil and gas. They've moved into mining. Both of these should be having fairly good time going forward, as we've seen from the commodity prices that are at these elevated prices. Mines are going to want to start adding capacity. They're going to want to start making more commodities out of the ground, and that's going to play well into the Murray & Roberts space. What I especially like about them, the last couple of times I've spoken with CEO Henry Loss, he's talked about the infrastructure division which they've had sitting in South Africa, which has done nothing. That hasn't done work in literally 2, 3, 4, maybe even 5 years. But they've kept it on the books, and they've kept the staff, and they've kept the capacity. And they took the view that it was a relatively small cost in the big picture, but what it gave them was optionality for when infrastructure started to return. Friday, we expect the government gazette of the 100 megawatt limit, where you can do 100 megawatt without needing a license. T's and C's there, but if that goes through as expected, that's probably going to be some 200 billion spend over the next 3 or 4 years, as not just mining companies, shopping centers, small businesses, everyone goes and starts building electric capacity, and that's going to add significant to them. They certainly had a tough 6 months to December. We've got a year-end June, results first week of September, a trading update in the next week or so. This year will be okay, but I think financial year 2022, running to June of next year, should be a good year for them. And then 23 and 24, even looking better. There's always a chance that Aton comes back potentially, makes another offer. They never appealed the Competition Commission's rejection of the order, so they might come back because they still sit there with that 45% stake. Currently, there's quite a large seller at about 10 Rand. So if you're interested in the stock, there is plenty to pick up in the market at this point. My second is Sibanye-Stillwater. You could almost pick any platinum stock. Your question you've got to ask yourself about a platinum stock is, do you think the PGM prices are going up, down, or sideways? I'm not convinced necessarily much higher, although rhodium, perhaps a special case, could start moving back to 25, maybe even 30,000 an ounce. But I think what we will see with the PGM prices over the next couple of years is probably them stabilizing. Platinum around the 1,000, 1,100. Palladium maybe a little lower at about $2,200, $2,400 an ounce. But we've seen a mismatch between the PGMs in the ground that are being mined versus the demand by the auto catalysts, the automotive industry more broadly. And that's not going to go away. And the ability to retool a factory to move from one PGM to another is simply just too costly. It's downtime. So if you've gone with the one PGM, you are pretty much stuck with that regardless what the price does. And the truth is, the cost of the PGM and the overall cost of manufacturing a motor car is relatively negligible. Why Stillwater as opposed to others? I like their palladium, which they get out of North America. They've got a little bit of gold as well. The gold doesn't particularly interest me in the least. They obviously started life as Sibanye Gold and then started moving into the PGM space. We've had the trading update. We'll have results out due around 26 August, last week of August. Headline earnings should be about R8.50. Puts me in a forward price earnings of around 4. I'm not expecting necessarily a large amount of capital appreciation, but I think we can see chunky dividends coming through. Certainly a 10, 12, even a 14% dividend yield is not impossible. The risk is twofold. One, they start doing big deals. That's my signal to get the heck out. Or two, that Neil Froneman, CEO, rather sends money into doing share buybacks than dividends. I'm old school. I would like the cash in my pocket, even though there's a tax consideration on that. The third is Purple Group, which is the stock I get asked most often about on social media and just out and about. People want to know about Purple Group. With over 1 million signed-on clients, 520,000 active accounts, in other words, funded accounts on the platform, people have got a special interest. It is their stockbroker. They've got Easy Equities and then a bunch of other little bits, Easy Properties, Australia, other bits and pieces. Those don't particularly thrill me. It's that Easy Equities component that really, really does. Their year end is August. We'll get a trading update probably towards early mid-October and then results sort of late October, early November. I'm expecting them to probably be able to do about 1.6, maybe 1.8 cents per share for the full year. But I think the market's going to be a little disappointed in the numbers. We saw it with JSE results. We see it on the daily volumes going through the JSE. Volumes are down. The hype and excitement of last year is past. Sort of normalcy in markets is starting to return. But what we do get from Purple is that giant base. 520,000 accounts in February. That number must surely be closer to 650, 700,000 now. They've moved past that tipping point. They're at the point now where they are profitable. If you're interested in it, not necessarily rush off. Maybe wait for a trading update. As I say, I think that might disappoint the market a bit. We might see some weakness and then some opportunity coming through there. So a good old-fashioned construction company, albeit moved into a lot of oil, gas, mining with infrastructure in Ryan Roberts. Sibanye-Stillwater, because I think PGMs remain the commodity space to be right now, and Purple Group because of that Easy Equities asset that they've got.
Simon, you never fail to deliver from an energy perspective. Great to have a construction stock in the league in terms of Murray and Roberts. And I need to point out that your Sibanye-Stillwater pick is similar. Well, it is exactly the same as Mia Kruger from Kruger International last week. She added one more thing that you didn't today, and that was that Neil Froneman himself is a master capital allocator. So she definitely put her vote in on Sibanye-Stillwater. and then Purple Group, as you say, at that tipping point with more than 500,000 sign-ups, something really to watch going into the future. For Simon Brown, thank you very much for joining us, the director of Just One Lap. Right, Chris Reddy, you are up next, sir. Portfolio manager at All Weather Capital, 15 years experience across a myriad of different elements: listed equities, fixed income, corporate finance, institutional and retail portfolio management. Your current role focusing on listed equity, and of course you've also got that duality in your role with fixed income and the analyst sector responsibility for property construction and investment companies. So I'm expecting your picks to come very much from that arena. I do know, sir, that you are an Arsenal supporter, along with Dr. Leila Fourie and, of course, the contingent from last week's session. And you have something in common with Simon Brown, that is, you are also a wine connoisseur. Chris Reddy, your time is now.
Perfect. Thanks very much, Bronwyn, for that kind introduction. I thought I might be in trouble going after Anthony, given his recent Twitter feeds, but hopefully I'll be able to share a bit more information on one of the companies he's already mentioned earlier. So starting off, my first company has actually been the best performing company on the JSE over the past 10 years. No, it's not Naspers or Capitec, but again, the small construction company called Afrimat. So as Anthony mentioned previously, the company was started in 2006 with the merger of the two aggregate companies being Prima and Lancaster. The CEO at the time is still the current CEO, being Andries van Heerden. I think in describing the Afrimat management team, a quote that comes to mind is one from Monish Prabhai, where he says, good management gives you upside options for free. And I think that aptly describes the management team in Afrimat, given the value creation that they've given to shareholders over the past year since listing. Now, we all know that investing is not about past returns and more about future cash flows. And I think that's what excites us most about this company, as it pivots from being a construction-focused company to becoming a mid-tier diversified miner. If you look at the most recent acquisitions that the company has done, given the Jenkins iron ore mine, the Inkomati anthracite mine, as well as the Gravenhag manganese asset, the beauty of Afrimat is that you are working off a very low base. So take, for example, the Jenkins mine that they've acquired last year. This is going to more than double the iron ore production from the company. Now, if you compare that to their peers, be it a Kumba or a Vale, Kumba would need to add on additional 40 million tons worth of coal, or Vale 320 million tons worth of coal, to have the same effect in doubling their production capacity. So it just shows you the base effects that you get from supporting a smaller company like Afrimat. In terms of their secret sauce, I think Anthony's touched on it in the past. They really have a truly exceptional management team with a phenomenal capital allocation framework. So the team would rather walk away from a bad transaction than doing a transaction just for the benefits of scaling up. So you really have to reward them in terms of just being strict in terms of how they use shareholder funds. They also have a high quality, diversified asset base with some clear competitive advantages around just lower cost operations. So at least that gives you a bit of a margin of safety when it comes to some softness that comes through in the commodity prices. And I think you also got to hand it to them in terms of how well they've diversified the business since listing. So focusing on construction first, then moving across to industrial minerals, and now moving more into commodities. So it's actually removed some of the risks that they had in the past in terms of concentration to a particular sector like construction or a particular client, say, for example, Sandra, when we saw some of the roads spend tapering off. So in terms of just wrapping up, I mean, even if we use our conservative iron ore assumptions, we still see significant upside to the share price from these levels, especially as the cash flows come online from the most recently announced acquisitions, and we are likely to see this in the cash flows over the next 6 to 12 months. So that's on Afrimat. On to my next stock, which is a bit of a more hotly debated topic. So what we've seen internationally is that there has been a trend from the global miners to dispose of some of their coal assets, given the focus on ESG. This is creating an opportunity for certain buyers to pick up assets at significantly discounted values to the current market prices. So the case being in point, if you look internationally, what's happened, Glencore's recently bought out a Colombian coal mine from BHP and Anglos, where they basically paid less than 1 times EV/EBITDA for the coal assets, And this is due to Anglo's and BHP wanting to dispose of their coal exposure within their base. We see a similar thing on the local front, which brings us to the second pick being Thungela, which was recently unbundled from Anglo American in June this year. Just some background to Thungela. So it has a market cap of close to 6 billion rand. They produce roughly 15 to 16 million tons worth of coal, of which the 55% of that is exported, predominantly to India. On the day of the unbundling, the share came under quite a bit of pressure, as we suspected, given some of the shareholders in Anglos who didn't want to hold a pure play coal asset. So it actually dropped to close to about 21 rand on the first day. At those levels, I mean, given our assumptions for coal and the earnings outlook for the company, it was trading at less than one times PE multiple, so offering significant value for investors. Our approach to looking at Thungela was instead of negatively screening for the asset, given the coal exposure, we rather tried to account for the heightened ESG risk via a higher discount rate when it came to the valuation discount or valuation that we applied, as well as including a higher rehab cost as well that would need to be incorporated once the various mines would need to be closed down. You know, in terms of key drivers for the company, we've already seen that coal prices are up nearly 40% from the June listing dates. So if you look at Richards Bay coal, it's close to about $137 per ton versus the 100 that we had at Thungela's listing. A couple of key drivers around this is that we are seeing a continuation of the political spat between China and Australia, which is now leading China to acquire more of its coal from the likes of Brazil, South Africa, and Indonesia. We've had some supply disruptions as well on the SA side, most recently the issues with the coal line from Mpumalanga to Richards Bay. And then also on the Indonesia side, they've had some bad weather impact their coal output, which has assisted the share price, coal prices from moving up. And then lastly, we've also seen heightened coal demand coming through from China and India, just given the economies opening up. So that, coupled with that, we've had a challenge in China with regards to hydropower being generated, given the droughts that they've had in certain regions. So that's also supported the share price. So given if you look at coal demand as well, we're still seeing more than 50% of demand for coal coming through from Asia, in particular China and India, which is then supporting the fundamental case for Thungela. And if you look at India's case, for example, more than 70% of their power generation is actually from coal. So that's unlikely to be removed anytime soon. So we still see strong demand fundamentals supporting the business case for Thungela. So wrapping up in that one, in terms of our business cases on Thungela, even with our lower coal assumptions, higher discount rates, and punitive costs on the rehab side, we're still seeing significant upside to the current 46, 47 rand share price. My last share is a small cap on the retail segment on the JSE. This is more of a turnaround story that we've seen, and the company is Lewis with a 3 billion rand market cap. It has had a tough period given the macroeconomic conditions over the past couple of years, but we do feel that these drivers are now changing given the past couple of year and a half, and the key drivers around our business case around Lewis is mainly focused around just, if you look at the strength of the consumer in that retail segment, the satisfactory book within Lewis's debtors book has significantly improved over the period. So if you look at the amount of doubtful debts that are coming through, it has reduced, which has then led to a knock-on impact in terms of just the return on equity within Lewis's debtors book. Also a very strong management team that's built up strong working capital given some of the supply chain issues that we saw from COVID. We've also seen very strong furniture demand, appliances demand as people worked from home. They've also been good recipients of the various COVID grants. There's talk of a basic income grant as well that should support the case of Lewis. And then from a balance sheet perspective as well, as Peter Lynch mentioned, he hasn't seen a company go bankrupt that doesn't have debt. So Lewis doesn't have any debt on its balance sheet, and they've been a big buyer of their shares. So bought back almost 20% of their shares. They recently received shareholder support last week to buy an additional 10%, and it's a strong dividend payer as well. So we still see further upside from Lewis. So we're a happy holder in that share. Thank you.
Chris Reddy, All Weather Capital, thank you very much. Great to see that endorsement for Afrimat coming through again after Anthony Clark's pick. And it's great to see great management being rewarded when it comes to an investment thesis. Andries van Heerden again being seen as a great capital allocator. Good to have Tongela on the log, great investment case, and then also exciting to have another turnaround story, Lewis coming into play. So now we move to Pete Fillion, who is from Counterpoint Asset Management, 25 years investment experience spanning Alan Gray, Investec, and then of course Pete, you founded Regarding Capital Management in 2003, merging with Counterpoint Asset Management in 2020, a like-minded investment firm. You're an investor first, you are an art and wine lover second, and cycling, I believe, interferes with all of the above. 6 minutes, you're up. Pete Fillion.
Thank you, Bronwyn. So before we talk about some of my favorite stocks, I think it's important to discuss the principles I apply when picking these stocks. It's important as I think process when making decisions in an uncertain domain is key. When you watch rugby players, quite topical, having beaten the Lions last week, which was great. When you watch rugby players train, they do drills over and over and over, the same drills, the process. They apply the same process over and over. They don't practice to score a try. They do a drill. And when they do that drill successfully on the field, sometimes it results in a try, but not every time. But what they practice is the drill. And the same with investing. You need to apply a certain process. And when managing money, that process is much more important than the specific outcome of any single decision, which is another way of saying, I'm going to pick 3 stocks for you today, but I have no idea whether it will be good picks or not. And the way I like to look at it is like a bundle of twigs. Each stock or twig is quite fragile. It can break quite easily. But if you tie them together in a bundle, in other words, a portfolio, you get something which is quite robust. So 2 of the principles I apply in my investment process is, first of all, I try and look for hidden gems. In other words, I look where no one else is looking. Fish where the fish are, not where everyone else is fishing, because it's probably fished out over there. And by the way, if it's a good idea, somebody else will also eventually find it and drive up the price. I also try and find good management that are in charge of running a good business. And as long as you don't pay too much, let them do the work for you. They're incentivized sometimes very well to do so, so let them get on with it. So with that intro, here are my 3 twigs. The first one, Savvest Capital. You've got a manager by the name of Chris Seabrook who's compounded the value of the business at twice the rate of growth of the All-Share Index over the past 10 years. The All-Share Index has done 11% per annum, which is not bad, given that inflation has been 4 or 5%. Chris Seabrook has compounded Savvest Capital's value by 22% per annum over the past 10 years. The net asset value of the business has gone from 9 Rand in 2010 to 74 Rand in 2020. And today you can buy that 74 Rand for 46 Rand per share. So why would you want to buy an index fund when you can get double the index return at half the price? This thing is on sale. If this were Pick and Pay and not the JSE, people would be queuing up around the block to buy it. Oh, and by the way, a large part of that net asset value is in businesses that operate offshore for all you Afro-pessimists. My second pick is, unfortunately, the same one that Anthony also picked. As I say, great minds think alike. That's CMH. CMH sells cars. Who cares? Another car salesman. But these guys are the best car salespeople around. This management team has been able to grow the earnings faster than the average company on the JSE over the past 20 years. Now, that's quite a good achievement. And you can buy that earnings power at a P of 9 today. They've generated a return on equity over 25% over the past 20 years as well. How have they been able to do this? Now remember, there's 2 things at play here. The first thing is when you walk into a car display room, you are buying an aspirational product and you are in a weak negotiating position. Everybody who's bought a car has felt that way. You walk in there and you want that car, and all of a sudden, price and those things don't matter that much anymore because you want that car. So you're in the weak negotiating position, which gives them pricing power. What gives them more pricing power is the second thing that they have going for them is car dealerships are mini monopolies. They are granted geographic rights by the car manufacturers. So if you want to buy a Ford in Cape Town, you have to go to a certain dealer. There aren't, it's not like Pick n Pay and ShopRite and Spar that also sell the same thing. You have to go to a specific dealer to buy that car. So they've got a little geographic monopoly, and that's how they've achieved these fantastic returns over the past 20 years. So you can put the shoe on the other foot today and become the strong party in the negotiations by buying shares in CMH. And it's on an 11% dividend yield. My third pick is one that's unfortunately been picked by two other parties today already. It's Afrimat. So I'm not going to go into Afrimat. I'm going to off-piste here. Sorry, Bronwyn. I'm going to off-piste here. I'm going to replace Afrimat with HCI, another investment company trading at about 60 Rand today, or 55 Rand, 60 Rand today. It owns businesses worth 144 Rand a share. It has been hard hit by lockdowns, coronavirus-induced lockdowns. Many of its businesses are to do with entertainment, so it's been hard hit. Also, it went into the lockdown situation where many of the businesses had been closed with too much debt on the balance sheet, and the market was very worried about emergency rights issues and having to fund the business. The management of that business has done fantastically well to steer that ship through having to close most of the business for months on end without diluting shareholders, without having to raise capital and diluting shareholders, and that is a tribute to the management of that business. On top of that, they have proven that they're good capital allocators. They also have two significant vectors of optionality. The first is they own a sizable stake in the Platinum Group Metals exploration project, which is years away from development, but it could be worth multiples of which is on the books for. And the second upside option, they own a couple of offshore oil and gas exploration blocks, some of which have been proved viable, and that could also be worth multiples of what they currently held on the books for. So that's my third pick, HCI. So there we go. HCI, SABE, CMH. Nothing sexy, just some proper hidden gems with good businesses run by great management. Buy the shares, bundle them up, sit back and relax. They'll do the work for you. In the meantime, you'll earn a nice little dividend yield. And if the Rand tanks, some of these guys' earnings power will improve. What more could you ask for? If instead you own the property, you probably earn less, especially after tax. Plus you get phone calls to fix the geyser, paint the walls, and so on and so on. The management teams you are buying here aren't going to bother you for money or complain that the neighbors are too loud. So just sit back, relax, let them do the work. The JSE allows you to make capitalism work for you, not the other way around. So don't complain about capitalism, take advantage of it. It's yours for the taking.
And Piet Fillion, in line with his deep, deep value investment thesis. Thank you very much for your time. Counterpoint Asset Management, just to reiterate again, Sabvest Capital, it's for sale, says Piet Fillion. We've got Combined Motor Holdings getting a double thumbs up. Of course, Anthony Clark coming forward with that one first. Afrimat was there, but then you very, very well went off-piste. That was a great maneuver into HCI. So we've got another play on the board. Thank you very much, Piet Fillion. Now, Alwayto Noche, Executive Director at Sentio. And, Sentio since 2011, Alwayto, previously Coronation Asset Managers, also time at Jacques Malan Consultancies and Actuaries. But wait for it, you are an aviation specialist. I have to put this to you that you fly the Sing 2, I hope I've got that right. And then you also have license to fly the Cessna 172. I wanted to get those technicalities in just to tee you up appropriately. But even more importantly, you are fluent in Mandarin and you speak almost all of South Africa's languages. So if I say Ni hao, Alwayto Noche, stage is yours.
Thank you very much, Bronwyn. So I'd probably characterize my stock picks as being South Africa COVID recovery plays, if you will. They kind of straddle both, or a couple of styles. They straddle the growth style and the value style. So to kick off, and will graduate in levels of risk as we go along. Probably our least risky proposition is Capitec currently. We're all very aware of the company. Great management team. Management team has been delivering year in, year out for a very, very long time. The business is on a sound footing to continue to grow the number of active customers. What does that mean? The number of active customers ultimately drives the transactional revenue growth. And as we know, banks tend to prefer transactional revenue as opposed to revenue from loans. The reason being is that they have to hold less capital on their balance sheet as a result of transactional revenue. So that's one great tailwind that the business has got. They're still generating about 100,000 new active clients every month, totaling 1 million people a year. And that base is forming a nice, solid base for their costs to operate off. The second vector of growth that Capitec is exposed to is its foray into the SMME space. So the acquisition of Mercantile Bank opens up that small, medium enterprise space to start servicing that part of the industry properly. Historically, the traditional Big Four banks haven't really done justice to that market, and the solution with which Capitec is approaching this SMME space is quite unique, innovative, and potentially may result in value unlock. There's also the third element of Capitec, which is it's always been perceived as a mashonisa of sorts, where it's a high interest rate unsecured lender, and that couldn't be further from the truth. If you actually start drilling down into the asset base and look at the quality of assets and the nature of assets that Capitec owns, you find that actually a significant part of their asset base is made up of government bonds, and I mean that isn't very risky at all. So we think that those 3 points augment or justify the reason why we think you should own the stock. Of course, there's no stock without risks. There is the risk of new entrants like Time Bank and Zero Bank, and the general industry trend towards low to no fees. We think that this could materialize in the longer term. However, in the short to medium term, we think that there's a significant runway for the business to continue growing. They generate very high returns on equities compared to the other banks, and they still continue to deliver on growth as well. So that's our first stock pick. Our second stock pick, I would say, was very, very badly hit by government-mandated lockdowns, and that's City Lodge. City Lodge, of course, is a hotel operator. Prior to COVID and the government lockdowns, they were operating at around 54% occupancy rates. When the government shut down travel, that plummeted, of course, and you saw only 17% of their rooms being occupied. Of course, at that level, you can't make a profit at all. In fact, they're loss-making. They have done a rights issue in order to shore up their balance sheet, so that's not a problem currently. It should allow them enough room to navigate the next couple of years without having to come to equity holders for more funding. They've also implemented some, let's call it some restructuring in their portfolio, where they've managed to weed out some underperforming businesses, in particular the East Africa operations. They also are getting better at occupancy management and ensuring that the pricing that they deliver into the market allows for their hotel rooms to be occupied in traditionally softer periods of the week, like midweek. So we think the management is quite long-serving. It's good. We think that there's definitely an opportunity for a recovery play here, in that if you look at the data, you can see that hotel occupancies industry-wide are starting to approach just below 30%. City Lodge needs 40% occupancy rates in order to break even, And we can see that the industry is headed that way, and we think that there's a potential opportunity with the stock at 4 Rand. We think it's still quite cheap. We think that conservatively the share is probably worth 5 Rand 20. Our third and probably our riskiest stock pick is Tsogosan Gaming. Again, this is an industry that was hit quite hard by the government lockdown and the closing of casinos. In that period, obviously, they couldn't operate. They had to do a lot of work on their cost base, on their employee costs, on their OPEX costs in order to right-size those costs in order to be able to survive the next couple of years. They managed to implement that. And as you saw government relax COVID measures, you also saw a significant recovery in gambling revenue. And you can see it in the key markets, Gauteng, Western Cape, KZN. The gaming, or the level of gaming, has recovered to about 70 to 80% of 2019, which is prior to COVID. So the strong recovery in gross gambling, the fact that they've managed to reduce their cost base or right-size the cost base for the softer trading market, leads us to believe that there's a good opportunity here. There is risk, however, in the stock, and it's centered on the financial leverage of the company. The business has got just under 11 billion Rand in debt, and their market cap is 8 billion Rand. The banks have seen that this business is a very good operator when allowed to operate in an unfettered manner. So they've waived their debt covenants on the debt for 2021. So we think they may narrowly escape having to do a rights issue. And should that happen, we think that there's a significant amount of upside in Tsogosan Gaming. We think that it's probably fairly valued at 10 Rand 20, and it's trading at 8 Rand currently. So those are our stock picks. It's Capitec with a target price of 2,000 Rand, City Lodge 5 Rand 20, and Tsogosan Gaming 10 Rand 20.
I'm just writing down there the target prices, Alwayto, really putting your head on the block. Capitec, Bank Zero, as you mentioned, competition heating up, Bank Zero launching to the public yesterday. And then great to see the hospitality and leisure industry getting some airtime with your picks on City Lodge and Tsogosan, giving the hammering that that sector has had. Just for everybody on the panel to consider this comment that's come through, is that most of the recommended equities are above their net asset value. I want you to think about that, because once we've heard from our final speaker, we're going to ask you to come forward and substantiate or really defend that position. But without further ado, it's Rajeh Ambakar. Thank you very much, Rajeh, founder of Excelsa Capital. More than 20 years financial services experience and 14 in investment space with African Harvest, Katie's, Prudential, and Investec all behind your belt. But more importantly, there's a sports theme that is unfolding here, and it is not Arsenal. You are, in fact, a league squash player, and that, Pete, you the kind of self-confessed cyclist that interferes with everything. And I happen to know that Dr. Leila Fourie is a mountaineer. So there's the sports theme that is unfolding. Rajeh Ambakar.
Thanks, Bronwyn, and good afternoon, all the listeners out there. So let me give you my stock picks. And as I was going through this process, I kind of thought through some of the larger cap stocks that we like out there in the market. You know, things like MTN, Impala, Sappi, and all of these, you know, are great investment opportunities. But, you know, having second thoughts, I thought these stocks may not be exciting enough for this tough crowd out there. So I decided to focus on 3 smaller cap opportunities. And, you know, we believe that all these 3 stocks could easily double over the next 3 years. And before I get into the stocks, you know, since I'm on air, I have to give a quick plug. You know, all of these stocks I'm going to talk about, they are in our Excelsior Equity Unit Trust. It's one of the best performing general equity unit trusts over the last 18 months, close to 100% up. So if you're more inclined to leave it up to the professionals, have a look at that. And then just to give you some context about what we do at Excelsior, we are valuation-driven investors, so we spend the bulk of our time as an investment team understanding a business and building fundamental valuation models. And importantly, as part of this, we actively take advantage of fear and greed. And, fear and greed is kind of this pervasive structural inefficiency that exists in markets, and we actively look for opportunities. So having said all of that, let me go to my first pick. And my first pick is a company called Metair. This is a company that has got two parts to it. There's an energy storage business and an automotive component side of the business. And energy storage in their case is essentially automotive batteries. They have operations in South Africa, but also more importantly in Turkey and Romania as well. And those businesses, especially in Turkey and Romania, are well placed to serve a large European auto market. They're also involved in start-stop batteries and lithium battery technology. And these are aspects of the business that are growing as more focus is put on carbon emissions from an ESG perspective. Also, just as an aside, the energy storage business is something that they are looking to possibly sell in the coming months, and that might unlock a lot of value within that part of the business. But the really exciting part about Metair is the auto components business in South Africa. Now, in South Africa, I'm not sure if you know, but we assemble about 600,000 vehicles a year, and roughly about 65% of those are exported. Now, Metair has recently won a contract with Ford, and this, together with other export opportunities, will see their volumes grow by about 30 to 40% over the next 2 to 3 years. And this is going to be the key driver of this business growing its earnings roughly 70% over the next 3 years. Now, as I said, we focus on valuation. Today, the business trades on roughly about a 7 PE, which is, in our view, very attractive, especially with the very strong earnings growth that's expected over the next 3 years. So that's my first pick. My second pick is a construction company, and it was a toss-up between Murray's, but I decided to go with Avenge. Now, Avenge is actually a 125-year-old construction business, but it's had a dismal last 5 years. From a poor, obviously, SA infrastructure market, it had debt problems, and it's actually had to go through 2 rights issues. So the market has rightly hammered the stock. The price has gone from roughly about 10 Rand in 2012 to 5 cents today. That's a big move. But today, Avenge is actually not a construction business anymore, at least a SA construction business. It's disposed of a lot of its businesses, and today there are 2 key businesses within it. There's Moolmans, which is essentially an open-cast mining contractor serving the commodity market in South Africa and in Africa. And there's McConnell Dowell, which is an Australian-based engineering and construction firm. Importantly as well, the balance sheet has been fixed and debt is no longer an issue. So why do we think it's cheap? I think firstly, Moolmans being exposed to a growing commodity capex cycle is very attractive. All the resource companies in our market and in Africa are benefiting from these high commodity prices, and we think that'll filter through to Moolmans. And then secondly, unlike in SA where our infrastructure market hasn't really picked up, McConnell in Australia is benefiting from a growing infrastructure market and has had a very strong and growing order book. So those are the businesses. But coming back to valuations, today Avenge has about a 3 billion Rand market cap. It has revenues of around 25 billion. And we believe they could make an operating margin of roughly around 5% on that 25 billion of revenue. So when you work through the income statement, this equates to roughly around 1 billion Rand of profits. So you have a 3 billion market cap, 1 billion possible normal earnings, currently puts it on a 3 times price earnings ratio. Very attractive from that point of view. And just also in our valuation, they actually currently have a business called Trident Steel, which is a steel wholesaler out there. And if you've seen ArcelorMittal's recent results, we think that business should be doing incredibly well as well going forward. Again, something that we don't build into our valuations, but we think is very attractive. So that's my second pick. Coming to my last stock, and it is similar to what Alwayto picked. In fact, it's the same stock. It's City Lodge. And this is been a recent acquisition for us. And again, similar to an Avenge, City Lodge, the share price has gone from roughly 30 Rand to 4 Rand in the last 3 years. That's again a big move. The business has had problems even prior to COVID from a weak SA economy, but COVID has really decimated the business in terms of the occupancies, as Alwayto mentioned. They also had a very poorly structured BE deal and have had to do a rights issue to shore up the balance sheet. So, why do we think it's attractive? Firstly, you heard about those occupancy levels and the impact that it has on a business with a largely fixed cost base. So the business is not making a lot of money, but we do think, and it is a tough environment, but we do believe that, COVID will pass, business and leisure travel will return, and those occupancies will pick up. So importantly as well, and a way to mention this, you don't need occupancy levels of 60% for them to make good returns. They've cut costs, and we think they can make very good returns at lower occupancy levels. So just why do we see value? Firstly, the replacement cost of the hotels is roughly more than double the current share price, which is attractive. But also, if you assume they make some sort of normal earnings, it puts the business on roughly about a 7 PE. That's very attractive when you look at hotels globally that trade on 14 to 20 times. So that's my third pick. Thanks for your time and happy hunting out there.
Well, Rajeh, you had me at these 3 stocks could double over the next 3 years. Just repeating there, Met-Air, Avenge, and City Lodge. Rajeh Ambakar, founder of Excelsior. Right, so I put it to you before we went into Rajeh, that comment that most of the recommended equities are above their net asset value. Who's going to weigh in here for me before we call this to Valdine ready to actually officially close the session?
Well, maybe I chose 2 investment holding companies, and one HCI is trading 60% below net asset value, and the other Sabes is trading about 40% below net asset value. But having said that, the operating businesses, can very well be bargains even if they trade above net asset value. It all depends on what sort of returns they generate on that capital.
I see Simon Brown nodding there. Rajeh also nodding.
There, just to say, when you're buying a business, you as Pete says, particularly in holding companies, you often get discounts. Don't get me wrong, love myself a discount. But what we're buying in a company is not the breakup value. We're buying that ability for it to generate profit over the years and decades ahead. And that's typically why stocks are going to be trading above net asset value. For me personally, I'm just not smart enough to pick between value and value traps. So I typically stay away from the discount to NAV.
I think we've put that issue to bed. I want to quickly just recap. We had Anthony Clark with CMH, Combined Motor Holdings, Afrimat, and York Timbers. Simon Brown, Marion Roberts, Sibanye Stillwater, echoing Mia Kruger from Kruger International last week on that Sibanye Stillwater pick. And then Purple Group coming in. Chris Reddy, Afrimat, Tungela and Lewis. Again, Afrimat has featured heavily in today's session. Big endorsement for Andries van Heerden and his management team. Again, reiterating, great capital allocators. I've heard it over and over. Piet Fillion, Subvest Capital, it's for sale. Combined Motor Holdings getting a second pick today, and then Afrimat, but we went off-piste again, and you brought in HCI there. So that was very nifty maneuvering on the slopes, Mr. Fillion. Coming to Alwayto, we had Capitec in light of their current play, City Lodge from a hospitality perspective. And again, hospitality and leisure getting a double header with Tsogo Sun coming into the fold. Rajeh coming in, Met-Air, new to the log. Avenge, you nearly went with Marion Roberts. And then again, City Lodge being endorsed on the session. So Valdine, I think we've got value on today's SA Stock Pick session. I'm going to bring you in as Director of Capital Markets to formally close today's session.
Thank you, Bronwyn, and thank you to our 6 industry guests. It's really been awesome, and a huge shout out and thank you to our audience that joined us. Huge numbers from last week, good lives watching today, and will be on repeat throughout the week. So we look for excellent take up. I just think it's awesome to have the platform to showcase some of our South African stocks. Just as a quick recap, we had 6 industry experts last week showcasing 18 stocks, no duplicates. This week we had 15 unique names, and over the 2 sessions, 32 unique South African stocks have been showcased and profiled. So really opportunistic and awesome value, and showcasing for our South African companies listed on the Johannesburg Stock Exchange. So we really thank you for your time. Happy investing to everybody out there, and we look forward to increased awareness, robust conversation. So please keep the dialogues going. And as mentioned, we will look to make this as a regular session, probably a monthly session. So stay tuned, watch the space, and we will keep rotating from different voices, diverse voices in the industry. So really we'll keep it fresh and exciting. Thank you for your time and have a good afternoon.